Welcome to ZZ Financial. We're dedicated to providing the most accurate, valuable, and timely information and analysis.
And good evening to all of you joining us. It's getting late here on August 27th. That's a Wednesday, around 11 p.m. Eastern Time, 8 p.m. out on the West Coast. And tonight, wow, we're really going to try and cut through all the noise. We want to bring you the most critical insights. We've got a really rich stack of, real-time financial news, market analyses, corporate updates, all of this actually hitting the wires on August 28th, 2025, Japan Standard Time. So our mission today really is to deep dive into these events that might seem separate at first glance. We want to connect them, find the threads, create a coherent and hopefully compelling narrative. We want to make sure you walk away not just informed, but genuinely well-informed with a clear sense of what's really driving the global markets right now.
That's exactly right. And I'd argue this particular moment, this snapshot in time, it offers a fantastic example, almost a master class, in how interconnected everything truly is. What's really crucial to understand, I think, is that every single piece of information we're going to talk about today, whether it's, a presidential announcement, a subtle hint from a central bank, or even a tech giant's quarterly report, none of it exists in a vacuum. Each one sends out ripples. It creates this complex, high-stakes financial story that, it reverberates across the entire investment landscape.
Yeah.
So we're here to help you not just see what's happening, but to really grasp every critical move in this really intricate global game.
Okay, let's definitely unpack this. And maybe we should start with a story that's really grabbing headlines right out of the U.S. We're seeing this significant tension brewing between President Trump and the Federal Reserve. Now, this isn't just like everyday political back and forth, is it? It feels like it's sending some serious ripples through the financial world. What exactly is going on here, and why should we, the average person, really care?
This is genuinely a pivotal moment, and it really shines a light on how directly political actions can, impact the very foundational economic structures we all rely on. So on the 25th, President Trump announced he intends to dismiss Federal Reserve Governor Cook. Now, Governor Cook, in response, has publicly said he plans to sue, calling the dismissal illegal. The core issue at stake here, and this is key, it isn't just about one person's job. It's seen as a potential threat, a serious one, to the Federal Reserve's independence. This institution, the Fed, it's designed specifically to make monetary policy decisions free from, short-term political wins and influence. Think of it like a neutral referee in a really crucial sports game.
Oh, okay, I get that analogy. It's like if the coach of one team suddenly tried to fire the referee right in the middle of the championship game, even if the ref doesn't actually leave the field immediately, everyone watching, and definitely the players, they'd start questioning the whole game's integrity, wouldn't they? It would just create chaos and, undermine trust.
Precisely. You've absolutely nailed the sentiment there. This isn't just some internal DC squabble. It carries the potential to seriously undermine global confidence in the U.S. dollar. And the dollar, as you know, it's the bedrock. It's the foundation of international finance and trade. So if investors start to perceive that the central bank's decisions could be politically motivated or dictated, that introduces this unpredictable element that capital markets absolutely hate. Right now, you see a lot of market participants kind of in a wait-and-see mode, given the legal questions, the lawsuit threat. But the move has definitely created this underlying unease across the board. The question isn't just about this specific dismissal, is it? It's about what it signals for the future of central bank autonomy. Could this set a precedent? Could it erode the independence of other central banks globally? It really raises a fundamental question. How does even a perceived threat to a central bank's independence impact global trust in a currency's stability, its predictability? That's what investors crave above all.
That makes total sense. Yeah, the ref can just be fired by one team. How fair can the game actually be? You lose faith in the outcome.
Exactly. And the seriousness, the gravity of this situation, it's reinforced by public comments from key Fed figures themselves. New York Fed President Williams, for instance, he publicly emphasized just how critical it is to maintain the Fed's independence. His remarks really underscore that this isn't just politics as usual. It's seen as a challenge to the very system designed to shield economic policy from those short-term political pressures. And that shielding is absolutely essential for long-term stability and for maintaining the dollar's global standing. It's a warning shot, for sure, about protecting that institutional integrity.
Wow. Okay, so it's a big deal, definitely. And here's where it gets really, really telling, I think. Amidst all this political friction, with the Fed, gold prices are absolutely surging. We're talking near record highs. Is this the market basically shouting its anxiety? Is that what's happening?
It's perhaps more than just a shout. It feels like a very clear alarm bell ringing. Gold is indeed having what you could call a truly golden moment. Just today, the 27th, gold futures for the December contract on COMEX, that's the main U.S. futures market for metals, they were trading around $3,400 per troy ounce. That's getting very close to the peak we saw back in early August. Now, to put this into perspective, think about this. Since early 2024, when gold was hovering around $2,000, prices have shot up by an incredible 70%. That far outpaces the S&P 500's rise, which is about 40% over the same time frame. So this isn't just a simple flight to safety. It feels more like a stark indicator of, well, eroding institutional trust being priced right into global finance. It seems like a direct consequence of this perceived political interference in something as fundamental as central bank independence.
Wow, 70% is just huge. So what are the usual reasons gold rallies like this, the traditional drivers, and how do they specifically connect to everything that's happening right now?
Yeah, historically, gold tends to rally based on a combination of key factors. You've got lower interest rates, fears about inflation picking up, dollar weakness, and of course, heightened geopolitical risks. And if we connect these traditional drivers to the bigger picture right now, well, you can see all of them are intensely in play. It's almost a perfect storm for gold. First, you have lower rates. Fed Chair Powell's speech at Jackson Hole on the 22nd, it pretty clearly opened the door for a September rate cut. Market participants are now pricing in something like nearly 90% probability of that cut happening. Lower rates make non-yielding assets like gold much more attractive because, well, the opportunity cost of holding it goes down. Okay, that makes sense. Lower rates, gold looks better.
Yeah.
What else?
Second, inflation fears. There are these lingering worries about inflation, partly fueled by the reciprocal tariffs being imposed by the Trump administration. These tariffs, they increase import costs, right? And those costs can eventually get passed on to consumers, stoking inflation concerns. Third, dollar weakness. As we were just discussing, President Trump's actions regarding the Fed governor are definitely casting some doubt on the confidence in the dollar itself. That makes gold, which is seen as stable, a more appealing alternative, especially for international investors.
And fourth, geopolitical risks. These just don't seem to go away. The ongoing Russia-Ukraine conflict, the deadlock in the Middle East, particularly tensions around the Strait of Hormuz. These persistent global flashpoints, they keep investors nervous and drive them towards traditional safe havens like gold. And there's another factor, a really powerful one, boosting prices right now. Central banks. Central banks around the world are actively increasing their own gold reserves. This isn't just individual investors, it's sovereign nations rebalancing their portfolios. That adds a significant layer of structural demand. And we're also seeing gold mining stocks like Newmont, for example, surging even more than gold itself. That often suggests there's a deep underlying strength in this demand. It hints that, the smart money sees this as potentially a longer-term trend, not just a fleeting spike.
So pulling this all together, what does it mean for us, for everyday people? Is gold acting as that alarm bell you mentioned, maybe signaling deeper uncertainties ahead, perhaps even about the strength of the U.S. dollar in the long run?
I absolutely believe it is. Gold's role as a warning signal seems to be becoming increasingly prominent, especially when you consider it alongside the backdrop of rising U.S. government debt and these growing doubts about the dollar's future stability. It's telling us that investors, both the big institutions and individuals, are actively seeking tangible security in what feels like an increasingly unpredictable world. They're questioning the very bedrock of traditional financial systems.
Oh.
So it's not merely a hedge against inflation anymore. It feels like a reflection of deeper systemic concerns about financial stability and global trust. It really makes you pause and wonder, doesn't it, about the fragility of systems we often just take for granted. This isn't just about numbers on a screen. It's fundamentally about trust.
That's a really powerful point, trust. And this ripple effect, from geopolitics, it isn't just being felt in gold, is it? It's also making waves in the crude oil market and even in the shipping industry. This interconnectedness is truly striking. It's like everything is connected by these invisible threads.
You're absolutely right, and it's particularly striking just how sensitive these global commodity markets are to geopolitical twists and turns. We're seeing freight rates for VLCCs, that's very large crude carriers, the massive tankers, on a clear upward trend since August. And the expectation is that this will likely continue through the end of 2025. This surge, it's driven by a pretty strong combination of both demand and supply factors. On the demand side, you've got Middle Eastern oil-producing countries boosting their production. Now, typically during the summer, a lot of that crude gets diverted for domestic electricity generation, for air conditioning demand. But after September, exports are expected to increase significantly, which naturally pushes up the demand for shipping. Then, on the supply side, there's been a limited number of new ship completions in 2025. So the global supply-demand balance for these huge tankers remains extremely tight, and that naturally supports higher shipping rates.
Okay, so more oil needs shipping and fewer new ships are available to carry it.
Yeah.
That makes sense. Prices for transport go up. But how do global politics specifically play into this beyond just general supply and demand?
This is where it gets really complicated and frankly quite fascinating. Let's take the Strait of Hormuz, for instance. That vital choke point, Iran's, let's call it a hint of potentially blocking the strait back in June. That caused immediate market fluctuations globally. There was a rush to secure ships, and risk premiums shot up. The possibility of such a closure, it still looms large. It creates this continuous potential for sudden, really dramatic market shifts. Now, get this to the broader picture. The situation in Ukraine is also significantly impacting the tanker market dynamics.
Okay.
The U.S. is putting pressure on India, significant pressure with additional 25% tariffs. That brings the cumulative total up to 50%, all because India continues to purchase Russian crude oil. And Europe, too, they plan to ban petroleum products that are manufactured using Russian crude by 2026.
Whoa, a 50% tariff? That's huge. What would that actually mean for India's oil sources? Where would they turn?
Well, the consequence here could be really significant. If India is effectively forced to switch away from Russian oil and turn more towards Middle Eastern oil, that would dramatically strengthen demand for legitimate tankers, as opposed to the so-called shadow fleets that are currently secretly transporting Russian oil. This shift would push freight rates for regular tankers even higher and could fundamentally reshape global oil trade structures. It's like a high-stakes game of musical chairs playing out on the ocean, and these tariffs are adding a whole new layer of complexity to where oil flows and how it gets there.
It really is like that. So what does all this mean for the price of oil that we eventually pay, at the pump? Does the higher cost of shipping ultimately get passed down to consumers like us?
Absolutely. Higher VLCC rates typically feed directly into higher crude oil prices. We've already seen WTI West Texas Intermediate crude rebound by about 1.4% today, up to $64.15 per barrel. A key driver for this recent jump was the report from the U.S. Energy Information Administration, the EIA. It showed larger than expected drops in crude oil inventories, which signals a tightening supply-demand balance right here in the U.S. Gasoline inventories also declined, confirming pretty robust demand, especially with a 3-day holiday weekend coming up. And then, layered on top of that, you still have these continued expectations for Federal Reserve rate cuts. Lower rates generally tend to stimulate economic activity and, by extension, energy demand. So yes, it's all connected from that geopolitical chessboard right down to your gas tank.
Okay, so while gold and oil are reacting strongly to these big global shifts, the Japanese yen seems, kind of caught in its own unique situation, doesn't it? It's struggling to appreciate much, even when there are some factors that seem like they should be positive for it. It's a curious picture, almost like it's trying to swim upstream.
It truly is a fascinating case study in currency dynamics. The yen is, yes, rising slightly against the dollar. It's trading around that 147.35 to 147.45 JPY per USD level. And that's primarily due to falling U.S. long-term yields, which narrows the Japan-U.S. interest rate gap. That's the main driver there. However, what's particularly striking, as you noted, is the persistent yen selling pressure. Its appreciation has been surprisingly limited despite these seemingly favorable factors. The core issue here, and this is really crucial to understand, is Japan's overwhelmingly low real interest rates. They currently stand at about negative 2.6%.
Real interest rates. Okay, could you maybe break that down? What does that actually mean in, simple terms for someone who doesn't follow this stuff every day?
Of course, absolutely. Think of real interest rates simply as the true purchasing power return on your money after you account for inflation. So it's the nominal interest rate, the rate you see advertised on a savings account or a bond, minus the current rate of inflation. So if inflation is high, let's say 3%, and your nominal interest rate is very low, maybe 0.5%, then your real interest rate is negative 2.5%. Your money is actually losing purchasing power over time. That's essentially what Japan is experiencing right now. And just for comparison, the U.S. real interest rate is around positive 1.55%, and Australia's is about positive 0.8%. So Japan's negative 2.6% is significantly lower.
Ah, I get it. So basically your money is effectively shrinking because inflation is eating away at its value faster than it's earning any interest. Okay, so why does that cause the yen to struggle so much?
Exactly right. And as long as this real interest rate remains so deeply negative, investors have a strong incentive to engage in what's known as yen carry trades. What that means is they essentially borrow money cheaply in yen. because the interest rates are so low. And then they sell those yen and use the proceeds to buy higher-yielding currencies or assets in other countries where they can get a better real return. This constant selling of yen creates continuous downward pressure on its value. The Bank of Japan's, the BOJ's cautious stance also plays a really significant role here. Governor Ueda's recent comments at the Jackson Hole Symposium, where he noted Japan's tight labor market and rising wage pressures, they basically reaffirmed a wait-and-see approach regarding aggressive rate hikes. Market expectations right now are for the BOJ's policy rate to only reach about 1% by the end of 2026. That implies maybe just 2 modest hikes over the next couple of years, and frankly, that just isn't seen as aggressive enough to significantly close that real interest rate gap with other major economies anytime soon.
Right. So even if the Federal Reserve starts cutting rates over here, the BOJ's super gradual approach means the yen might just keep struggling to gain any significant ground. It's almost like the market is shouting, show us more, BOJ. We need a bigger reason to hold yen.
Precisely. It's a very clear message being sent by the markets. And this is where things get even more complex, because algorithmic trading adds another layer to these currency movements. We've seen the widening spread between the 2-year and 30-year U.S. Treasury yields, that steepening yield curve we talked about, combined with the political risks, like Trump's move against the Fed, trigger significant algorithmic dollar selling. The machines react instantly to these signals. However, it's not just a one-sided story where all that money automatically flows into the yen. The political risks exist for the yen too, right? There's uncertainty surrounding the current Shiba administration in Japan. And there are risks for the euro as well, stemming from recent French political turmoil. This contributes to existing short positions bets against the yen and the euro by these speculative algorithmic traders. Currently, it seems these sophisticated algorithms are prioritizing the U.S. risks. That suggests the dollar's vulnerability, at least in the immediate short term, is seen as the more pressing issue and therefore the bigger trading opportunity.
Okay, let's switch gears now and zoom in from currencies and commodities to the corporate world. Specifically, let's talk tech titans. Everyone, absolutely everyone, has been watching NVIDIA, the undisputed king of AI chips. Their latest earnings report just landed, and reading through it, it feels like, well, a bit of a mixed bag, doesn't it? Maybe not the clear, unadulterated home run some people might have been expecting.
You've hit on a really important observation there. It definitely presents a complex picture, not just a simple good or bad story. Let's break down NVIDIA's Q2 2025 earnings, which cover the May to July period. So the good news first. They reported absolute record high revenue of $46.743 billion. That's up a staggering 56% compared to the same period last year. And it did beat market expectations, which were around $46.05 billion. Net profit also surged, up an impressive 59% to $26.422 billion, another record. This was all clearly driven by incredibly strong demand related to AI, as companies globally just keep pouring money into building out AI infrastructure. Now, looking ahead, the future outlook also looks strong on the surface. For Q3, which is August to October, the revenue projection has a midpoint of $54 billion. Again, that's comfortably above what the market was expecting, around $53.4 billion. The board even approved a massive $60 billion stock buyback program, which usually signals strong confidence from the company itself.
And CEO Jensen Huang, he sounds very optimistic, talking about their new Blackwell Ultra chip production going at full speed and estimating that total investment in AI infrastructure could reach a mind-boggling $3 to $4 trillion by the year 2030. That's just an almost unimaginable amount of spending.
Wow, okay, those numbers sound absolutely incredible. Record revenue, record profit, super optimistic outlook, huge buyback. I mean, where's the mixed bag part then? Why on earth would the stock dip after hours with news like that?
This is exactly where those deeper geopolitical forces really slam into the corporate reality. There's a significant shadow hanging over these otherwise stellar results. While the overall revenue is strong, their data center sales, which is the core business driving all this AI growth, came in at $41.1 billion. Now, that actually slightly missed the market's forecast, which was $41.34 billion. It's a small miss, yes, but in this high expectation environment, it definitely caught people's attention. And then there's what you could call the China problem. NVIDIA explicitly reported no sales of their specially designed China-targeted H20 chip to any customers based in China during that May to July period. And crucially, shipments of that H20 chip are specifically excluded from their revenue outlook for the current August to October quarter. This is a direct consequence of those escalating U.S. government export controls we've talked about. You know, there was that brief reversal, but then a new policy came in requiring a hefty 15% payment to the U.S. government for any sales of these China-targeted chips. And to compound the issue, reports suggest Chinese authorities themselves are actively discouraging the use of these H20 chips, clearly signaling their push towards developing domestic alternatives. So what's really fascinating here is that even with record profits and a generally optimistic future, these geopolitical uncertainties swirling around China are acting as a significant drag, a real burden on the stock price. In after-hours trading, NVIDIA stock did dip about 5%, despite beating the overall forecasts. And that's likely due to a combination of factors. Maybe some profit-taking after the stock's massive run-up, but definitely also that deep, persistent uncertainty about the future of their China business. This isn't just about one lost market for NVIDIA. It feels like a stark preview of how this political fragmentation we're seeing globally is forcing a costly, probably inefficient split, a bifurcation of global tech supply chains. This isn't just a challenge for one company. It feels like it's fundamentally reshaping the geography of innovation itself. And that's a really big deal for the entire global economy.
So yeah, definitely not a clear home run then, because even this AI giant isn't immune to global politics. What does this signal for other companies in the whole AI ecosystem, especially those that rely heavily on NVIDIA's chips or, just ride their coattails in the market? It really is, like you said, NVIDIA's the sun, and the rest of the semiconductor galaxy just orbits around it, reacting to its light and, well, its shadows too.
That's a great analogy, and it's absolutely how it plays out in the markets. NVIDIA's results immediately create these ripple effects across the entire semiconductor sector. Take Advantis, for example. They supply crucial inspection equipment for these incredibly complex chips. Their stock saw some really volatile movements right after NVIDIA's report. Initially, it fell down about 3.6%, just dragged down by NVIDIA's after-hours decline. But then, interestingly, it showed a slight recovery as some investors started buying on the dip. And this highlights a fundamental point. The ever-increasing complexity of these new AI chips like NVIDIA's Blackwell now and the upcoming Rubin plan for 2026, the complexity is actually a significant tailwind for companies like Advantis. Their specialized testing equipment becomes even more critical, more indispensable for ensuring quality and performance. However, the broader trend immediately following the report saw other semiconductor giants feel the pressure too. Companies like AMD, TSMC, Broadcom, Marvell Technology, and Micron Technology all saw their stocks decline in after-hours trading. NVIDIA's sell-off kind of spread, fueled by those underlying concerns about a potential slowdown in the breakneck pace of AI demand, and especially that lingering uncertainty around the exclusion of China sales. It's a stark reminder of just how tightly interconnected this hardware ecosystem really is.
Okay, but what about the software side of this whole AI revolution? Are they seeing the same kind of mixed signals, or are they maybe a bit more insulated from these, geopolitical hardware struggles and supply chain issues?
Yeah, the software side does present a slightly different, and in some cases a distinctly more robust picture right now. It suggests that the benefits of the AI revolution are definitely spreading beyond just the companies making the physical chips. Look at MongoDB, for instance. Their stock absolutely soared up an incredible 34% intraday. That came after their Q2 results smashed expectations and they raised their full-year guidance significantly. What drove that? Primarily, it was the accelerated growth in their cloud database offering called Atlas. Analysts were quick to praise MongoDB's potential as a key secondary beneficiary of the AI revolution. They noted that its database technology is really foundational for many AI applications, even before you factor in direct profits from specific AI features. Morgan Stanley even raised their target price quite substantially. Similarly, Snowflake, another data warehousing company, surged sharply up 14% in after-hours trading after they raised their own full-year product revenue forecast. Their growth is increasingly being driven by new AI-based services and attracting more large enterprise customers who need to manage vast amounts of data for AI.
Okay, so some really positive signs on the software side, but not all smooth sailing.
No, not universally positive. It highlights how sensitive the market is right now. Take CrowdStrike, a big name in cybersecurity. Their stock actually fell quite sharply, over 8% in after-hours trading. Why? Because their Q3 revenue forecast missed the consensus estimate even though their actual Q2 results were strong. This just underscores how highly valued tech stocks are right now. Even a slight miss on future guidance can trigger a significant sell-off, especially in a competitive field like cybersecurity. And then you have HP, the well-known computer and printer maker. Their stock also declined over 3% after hours, mainly due to a disappointing profit outlook. They specifically cited pressures from high tariffs and the costly, complex process of relocating parts of their production out of China. That echoes some of the geopolitical challenges NVIDIA is facing on the hardware side. This all kind of ties back to an argument we're hearing from analysts like those at Wedbush. They keep saying the AI revolution is still early. They suggest that the full benefits of AI might still be underestimated across the broader economy. And they think interest in potentially undervalued software stocks could actually intensify now that NVIDIA's major earnings event is behind us, as investors start looking for that next wave of AI beneficiaries beyond just the chip makers themselves.
Right, looking for who else benefits down the line. And beyond all the tech headlines, other sectors are definitely making news too. I mean, from donuts to department stores, the corporate landscape is always shifting, always dynamic, showing a really diverse set of forces at play, isn't it?
Absolutely. The market is never just about one sector. And these diverse corporate stories are fascinating because they reflect how different companies are adapting to this complex mix of global economic shifts and very specific localized pressures. For instance, in retail, you're seeing almost a tale of two strategies playing out. Look at Kohl's, the department store. Their stock surged, up as much as 29% at one point. That was on the back of better than expected Q2 results and them raising their full-year guidance. They attributed their success to focusing on private brands, offering deep discounts, and implementing aggressive cost cuts, clearly adapting to an environment where consumers are feeling frugal and looking for value.
Okay, so Kohl's is doing well by focusing on value. What's the contrast?
Well, in contrast, you have Krispy Kreme. Their stock fell about 3.4% after JP Morgan actually downgraded it to sell. The analysts expressed doubts about the company's earnings recovery path, especially after Krispy Kreme terminated its high-profile partnership with McDonald's and announced it was reviewing its high-cost delivery strategy. It really highlights the challenges of balancing, product novelty and buzz with sustainable, profitable economics. And then, almost out of left field, Swiftonomics made a surprising appearance. American Eagle Outfitters saw its stock rebound, up as much as 9.1%, apparently boosted by announcing a brand partnership with NFL star Travis Kelce. And interestingly, his recent engagement to Taylor Swift was also cited as boosting other seemingly unrelated brands like Signet Jewelers and Ralph Lauren. It just goes to show you, sometimes the most unexpected cultural forces can move these markets, doesn't it? It's not always just about earnings per share.
Swiftonomics. That's hilarious. I bet financial analysts everywhere are now scrambling to add celebrities' social media feeds to their Bloomberg terminals. That's just wild. Okay, what about some of the unique stories that are emerging from Japan? We get a lot of news flow from there.
Indeed. And in Japan, we're seeing a really interesting mix of strategic global expansion, internal restructuring, and also some very localized challenges. Sompo Holdings, a major Japanese insurance group, saw its stock hit an all-time high, rising over 6.4%. This came after they announced a significant acquisition buying the U.S. insurer Aspen for over 500 billion yen, which is a huge deal. Their stated goal is to strengthen their earnings base in the U.S., particularly in specialized fields like cyber attack insurance. So that's a clear sign of strategic global expansion. Similarly, Eternal G, the company that operates the popular Torikizoku Izakaya chain, known for its very cost-effective yakitori, their stock rose almost 3%. That was on news they're planning to expand to 100 stores in Shanghai, clearly leveraging their successful low-cost model and riding the growing demand for Japanese food overseas. Fuji Oil Holdings also hit a 6-year high, jumping 8.5%. They announced a new midterm business plan with ambitious targets, aiming for 3.4 times their current operating profit by March 2028, along with higher return on equity, ROE, and a bigger dividend payout ratio. That signals strong confidence in their internal growth prospects.
Okay, so some strong expansion and growth stories there. But I imagine it's not all positive news.
No, definitely not. We also saw Daido Group Holdings, a beverage company. Their stock hit a year-to-date low, plummeting over 7%. They projected a substantial net loss around 3 billion yen for their fiscal year ending January 2026. They cited weak domestic beverage sales, but also, interestingly, the complexities of applying hyperinflation accounting standards to their operations in Turkey. That really highlights the challenges companies face when operating across diverse and sometimes volatile economic landscapes. Elsewhere, Shibara Electronics hit a record high. This came after the Taiwanese electronics giant Yageo announced it reached an agreement with Japan's Ministry of Economy, Trade and Industry, or MITI, regarding its review of Yageo's planned tender offer bid, TOB, for Shibara. This makes Yageo's offer of 7,130 yen per share look highly likely to succeed over a competing bid. Sanrio, the company famous for Hello Kitty, saw its stock rebound about 3.6%. That followed an upgrade from SBI Securities, which raised its target price to 10,000 yen, citing Sanrio's ongoing global branding success and its ability to continually expand its fan base across generations. And Trial Holdings, a discount store operator, rose over 4.5% to a year-to-date high. Investors seem optimistic about the potential synergies from its recent acquisition of the major supermarket chain Seiyu. Trial plans to renovate Seiyu's aging stores and develop new store formats. Just a couple of other quick notes. Hino Motors, the truck maker, had to extend a production halt at its Ibaraki factory, citing ongoing part shortages. And Fujitsu announced it's working with NVIDIA, actually, to automate parts of medical consultations using AI, with plans to launch that service within the year. It shows how AI integration is really starting to touch even very traditional sectors now.
Right. And speaking of NVIDIA and its challenges selling advanced chips to China, it really seems like China isn't just sitting back and waiting, are they? Reports suggest they're making some really big moves to develop their own AI capabilities almost directly in response to these U.S. restrictions. It feels like a technological arms race is heating up.
That's a very apt way to describe it. It does feel like an acceleration. There was a report, I believe, in the Financial Times indicating that key Chinese semiconductor manufacturers like Huawei and SMIC have ambitious plans to actually triple their production of AI-related chips by 2026. This looks like a clear, direct strategic move aimed at reducing their dependence on U.S. companies like NVIDIA. It really reinforces that idea we discussed earlier, this potential splitting or bifurcation of global tech supply chains along geopolitical lines. We're already seeing the rise of companies some are calling China's NVIDIA, like Cambricon Technologies. Their net profit apparently soared in the first half of 2025. And reports suggest major Chinese tech firms like Alibaba and Tencent are increasingly switching to these domestic chips, partly due to availability and partly perhaps due to government encouragement. Now, it's important to keep perspective. Cambricon's market capitalization is still vastly smaller than NVIDIA's behemoth size. But this aggressive domestic push really highlights the immense strategic importance China places on achieving self-sufficiency in AI, not just as a technological goal, but really as a matter of national security and future economic power. And just briefly touching on some other Chinese and Hong Kong economic news we saw, Meituan, the big delivery and local services platform, reported its H1 net profit fell by 38%. Their CFO explicitly mentioned facing unprecedented intense competition in China's fiercely contested food delivery market. That shows even giants face significant domestic challenges. Mixi Group, known for its low-priced bubble tea and ice cream, saw its overseas growth slow down. But interestingly, the trend towards low-priced goods domestically actually boosted their profits in China, perhaps indicating a broader shift in consumer spending habits toward value. On the macro front, China's overall industrial profits fell 1.5% year-over-year in July, although there were some signs of recovery among small and medium-sized enterprises, SMEs. And finally, over in Hong Kong, secondary home prices actually rose for the fourth consecutive month in July. It's still early days, but that could potentially signal a turning point, or at least a stabilization, in that property market after a pretty long period of decline.
Okay, let's pivot back then, maybe to wrap things up, to the central banks again. The Federal Reserve's next move is clearly top of mind for everyone. And after Chair Powell's recent signals, a September rate cut seems, well, almost inevitable now, doesn't it?
It certainly feels that way based on market pricing. What's really crucial to grasp here is just how quickly market sentiment can coalesce around a particular outcome, especially after a key event like Jackson Hole. It creates this powerful momentum. Federal Reserve Chair Powell's remarks, widely interpreted as dovish, have definitely opened the door wide for a September rate cut. So much so that, as we mentioned, market participants are now pricing in close to a 90% probability of a cut at the upcoming FOMC meeting on September 16th and 17th. However, there are important nuances to consider. Some economists, for instance, view a potential September cut less as the start of a long, aggressive easing cycle and more as a kind of preventive measure, an insurance cut aimed at warding off a possible recession down the line. Now, this distinction is important because if the market has already fully priced in this cut, and if the Fed's accompanying language suggests it might be a one-off or part of a very limited series of cuts, well, we could actually see some short-term profit-taking after the announcement. It's that classic buy the rumor, sell the news scenario playing out. We're also still waiting for Federal Reserve Governor Waller's scheduled speech on the economic outlook, which could provide more clues. And as we noted earlier, New York Fed President Williams has already sounded a cautious note, stating his intention to proceed cautiously with interest rate cuts. All this indicates that while cuts seem likely, the Fed will almost certainly remain data-dependent. They're unlikely to commit to a prolonged easing cycle without really compelling evidence that the economy needs it.
Right. So it's not just about if they cut, but the crucial context is why they cut. And importantly, what signals they send about what happens next. The market really is a fickle beast, isn't it? Always trying to jump ahead and anticipate the next move, which sometimes leads to these big overreactions.
It absolutely is. And that constant anticipation, that trying to read the tea leaves of central bank communication, it often drives significant short-term volatility. The market is perpetually weighing probabilities, and even slight shifts in the language used by Fed officials can have really outsized effects on asset prices across the board. This is precisely why Paying close attention to the nuances, the specific phrasing rather than just the headline news, is so incredibly critical for investors.
Okay, and then shifting across the Pacific again, the Bank of Japan is also squarely under the microscope. We're hearing renewed whispers about a potential additional rate hike there. Now, that would be a truly significant shift for Japan, wouldn't it? After decades of maintaining that ultra-loose monetary policy, often seemingly going against the global tide.
Yes, this is potentially a major development, one that could signal a real turning point for Japan's long-standing monetary policy stance. Expectations for a BOJ rate hike, perhaps as early as October, have indeed resurfaced in recent market commentary. This shift in expectations seems to be driven by several converging factors. Firstly, you have prolonged, stubbornly high prices in Japan. Inflation seems more persistent than initially thought. Secondly, there was an upward revision to Japan's Q2 GDP data, suggesting the underlying economic momentum might be stronger than previously estimated. And thirdly, there seem to be somewhat reduced concerns, at least for now, about the Japanese economy suffering significant deterioration as a result of President Trump's tariff policies. So, taken together, these factors suggest the Japanese economy might finally be robust enough to withstand a somewhat tighter monetary policy after battling deflation for literally decades. The market will be hanging on every word from BOJ Governor Ueda at the press conference following their next monetary policy meeting on September 18th and 19th. Everyone will be looking for any clear signals or forward guidance about their intentions. Adding weight to this possibility, Policy Board member Junko Nakagawa recently reinforced the potential for hikes. She stated quite clearly that if economic and price outlooks are realized, we will continue to raise the policy interest rate and adjust the degree of monetary easing. However, she also prudently added a note of caution, saying that uncertainty remains high, particularly regarding global trade policies. She flagged that as a key risk factor, noting that if rising import costs were to lead to downward pressure on the economy, that could change their calculus. What's already happening in anticipation of this potential shift is quite telling. Long-term interest rates in Japan have already climbed to around 1.6%. That's a 17-year high. And this rise is already providing a boost to Japanese regional banks and mega banks by improving their net interest margins, the difference between what they earn on loans and pay out on deposits.
It sounds like such a delicate balancing act for the BOJ, doesn't it? Trying to respond to inflation finally taking hold, but without accidentally stifling the economic recovery they've worked so hard to nurture. Given Japan's long, painful battle with deflation, is there maybe a risk that the BOJ's wait-and-see approach is still actually too conservative? Could they be missing a critical window to normalize policy more decisively and perhaps strengthen the yen more effectively?
That's an excellent and really critical question. It's definitely one that many economists and market watchers are actively debating right now. And yes, there absolutely is that risk you highlighted. The BOJ has been so profoundly scarred by those decades of deflationary pressures that caution is just deeply ingrained in their institutional DNA, you could say. Their primary focus, understandably, is ensuring that inflation and wage growth are truly sustained before they make any drastic moves. But the potential downside of moving too slowly is exactly what you mentioned. They risk losing the opportunity to effectively close that significant interest rate differential with other countries, the one driving those yen carry trades we discussed earlier. If they don't act decisively enough, the yen could remain vulnerable to that selling pressure for longer than necessary. It's a real tightrope walk for them, no question about it. Now, looking specifically at Japanese domestic bonds, we've actually seen long-term yields decline slightly recently. The benchmark 10-year yield is around 1.615%, and the 30-year yield is down at 3.170%. This dip was driven partly by the fall in U.S. rates, but also by some speculation that Japan's Ministry of Finance might review its upcoming government bond issuance plans, which could affect the future supply of bonds in the market. When we talk about how these government bonds are actually sold through auctions, it's quite an interesting process and often a high-stakes game for the primary dealers involved. Japan uses two main methods, the conventional auction method and the Dutch auction method. The conventional method is where bidders submit specific prices they're willing to pay. This can be quite nerve-wracking for the bidders, as the lowest accepted price sets the terms for everyone who bid at or above that price. It risks them paying more than they might have needed to and requires a complex strategy, balancing client orders, assessing market demand, and trying to guess what competitors might do. The Dutch method, on the other hand, is generally simpler. It results in a single, uniform lowest accepted price that all successful bidders pay, regardless of their original bid. This makes it somewhat easier to handle from a cost perspective for the dealers. There's an upcoming auction for 2-year Japanese government bonds scheduled for September 28th. The current expectation is for safe demand. meaning investors are likely to participate steadily, especially given the backdrop of potential BOJ policy shifts which could make shorter-term debt more attractive.
Huh. So even something that sounds as dry as a bond auction is actually a pretty high-stakes game with real strategy involved. Okay, and bringing it back to the U.S., that yield curve we touched on earlier is telling us a story too, isn't it? A story that seems to reflect both economic expectations and these rising political risks.
It truly is telling a dynamic story right now. The U.S. yield curve, specifically looking at the spread, or difference between the 2-year Treasury yield and the 30-year Treasury yield, has widened quite significantly. It's now around 1.38%, up sharply from the 1.12% just before Chair Powell's speech at Jackson Hole. This widening, the steepening of the curve, reflects two critical and actually quite intertwined factors. Firstly, it clearly reflects those heightened expectations of monetary easing lower short-term rates in the future, thanks to Powell's dovish stance. But secondly, and crucially, it also reflects a significant policy risk premium being built into longer-term yields. This is directly linked to President Trump's recent actions against the Fed's independence. Some economists are calling Trump's move to dismiss a Fed governor an unprecedented event in modern times. They argue it will undoubtedly leave lasting issues regarding the perception of Fed independence, and they anticipate further steepening of the yield curve, meaning longer-term rates rising relative to short-term rates and potentially renewed weakness for the dollar as a result. So it's a clear signal of market concern about both the future direction of the economy and the stability and predictability of U.S. political institutions. It's the market's way of saying, okay, we expect the Fed to cut rates soon, which pushes down near-term yield expectations, but we also demand a higher return, a bigger premium, for holding long-term U.S. debt because of this increased political uncertainty and the potential for greater volatility down the road.
Wow. Okay. So as we look ahead then, September is absolutely packed with economic events, data releases, central bank meetings, all things that will undoubtedly shape market sentiment. What specifically should be on our radar globally? What should listeners really keep an eye on next month?
Yes, September is shaping up to be a truly pivotal month, one that could very well define the market trajectory for the rest of the quarter, maybe even the year. We have a really packed calendar of key events to watch. In early September, keep an eye out for Eurozone unemployment and inflation CPI data. Also, the U.S. ISM Manufacturing and Services PMI reports will give us a timely read on business activity. And then critically, on September 5th, we get the U.S. employment statistics for August. That jobs report will be absolutely crucial for solidifying or potentially challenging those market expectations for a Fed rate cut later in the month. Then, moving into mid-September, we'll get revised GDP figures from Japan, the results from the European Central Bank's ECB Governing Council meeting, and another key inflation reading from the U.S., the Consumer Price Index, CPI, for August. That's followed immediately by the much-anticipated FOMC meeting results on the 16th and 17th. We also have Brazil's central bank setting its policy rate around that time. And towards late September, the action continues.
We'll have the Bank of Japan's monetary policy meeting, concluding on the 18th and 19th, followed by CPI data from the UK, updated inflation figures from Tokyo, which often leads national trends in Japan, and finally, the Fed's preferred inflation gauge, the U.S. Personal Income and Consumption Expenditures, PCE data, for August. It's just a relentless stream of potentially market-moving information throughout the entire month.
Okay, so a very busy calendar indeed. What about the overall market outlooks? What are people generally expecting for September?
While looking at some broad outlooks, for Japan's Nikkei average, the general expectation seems to be for it to consolidate around its current high levels, maybe in the 42,000 to 43,000 yen range. It should initially find support from those Fed rate cut expectations spilling over globally. However, the Nikkei could face significant headwinds later in the month if the Bank of Japan does indeed hike rates, as a stronger yen typically makes Japanese exports less competitive and can weigh on exporter stocks, which are a big part of the index. Turning to Indian stocks, there's a concern they may continue to face downward pressure, potentially falling further. This is largely due to those new U.S. tariffs, bringing the cumulative rate up to 50%. This raises serious concerns for India's export-oriented industries and could also potentially reignite inflationary pressures within India, making it less likely that the Reserve Bank of India's Monetary Policy Committee would consider rate cuts anytime soon. And finally, looking at domestic politics back in Japan, any lingering uncertainty over whether Prime Minister Ishiba will continue in his role could create some headwinds for the Japanese stock market. If overseas investors perceive instability or a lack of clear policy direction, they might become more cautious about investing in Japan.
Got it. So it really sounds like September is a month that could define the next quarter for many, many markets. We've got central banks playing this high-stakes game of wait and see, carefully watching the data, while also navigating some really significant political pressures, both domestic and international. It's certainly a lot to keep track of, but absolutely essential if you want to understand where we might be headed.
Wow, what an incredible deep dive that was. We've really covered the intricate dance between global politics and the financial markets today. We saw how gold seems to be acting as this clear warning signal, flashing amidst U.S. political friction and what feels like eroding institutional trust. We looked at the AI revolution, how it presents both this immense promise but also carries significant geopolitical risks, potentially leading to that splitting, that bifurcation of global tech supply chains. And we explored how the major central banks, the Fed and the BOJ, seem to be embarking on potentially divergent paths with their monetary policies, each facing its own unique set of challenges and pressures.
Indeed. And if you try to connect all these dots, connect the bigger picture, it truly underscores just how important it is to maintain a nuanced perspective. You really have to look beyond just the immediate headlines to understand the deeper currents that are actually driving these markets. Every piece of news we discuss, whether it's a corporate earnings report from NVIDIA, a geopolitical tension point like the Strait of Hormuz, or a subtle shift in central bank language, each one is like a thread in this incredibly complex global tapestry. And it affects everything from commodity prices like gold and oil to currency valuations like the dollar and the yen, and even, as we discussed, the very future of technological innovation and where it happens. It's just a dynamic, constantly evolving landscape.
So, thinking about all of that, for our listeners trying to make sense of it all, what's maybe one key factor, one big theme that you think we should all keep a really close eye on moving forward from here?
That's a great question. I think one really crucial thing to consider and to watch closely is how this confluence, this coming together of, on the one hand, increasingly nationalistic trade policies like the tariffs and export controls we're seeing, interacts with, on the other hand, a deeply globally interconnected technology supply chain like the one NVIDIA relies on. This clash, this friction, it creates entirely new and frankly quite unpredictable risks. Risks for innovation itself and risks for how we value corporations. The fundamental question going forward might not just be if innovation will continue, because it almost certainly will, but where it will primarily take root, under whose rules it will operate, and how that geographic shift ultimately reshapes global economic power balances for decades to come. This geopolitical fracturing of technology and trade, forcing companies to make these difficult strategic choices about production, partnerships, and market access, that will have profound long-term implications for investors all around the world. That, I believe, is the overarching story that we really need to keep watching unfold.
That's a really powerful thought to leave us with, and certainly something important to keep in mind as we watch all these pieces move. Thank you so much for joining us and sharing your insights on this deep dive. Stay curious, everyone, stay informed, and we'll catch you next time.
Thank you for listening. Looking forward to meeting again next time.